Hello, everybody, and welcome to our webinar about timing your exit. It's a nice summer afternoon. I really appreciate you taking your time out from your holiday schedule or if you're still at the office of your work schedule. We're here to talk about one of the favorite topics for me is that is timing. There's no perfect timing, I can say already. There is ways to get closer to a good timing, but you cannot get it perfect. So at least I hope that's a relief. Anyway, let me introduce myself as we have more and more attendees joining. I'm Marcin Majewski. I'm the founder of Aventis Advisors. I'm here with Filip. Say hi, Filip.
Hi everyone.
Filip is a director at our firm, and together we'll walk you through our philosophy of how to get as close to an optimal timing for an exit as you can reasonably do. We have a seminar today with where we walk you through 5 dimensions. So I guess we can dive in. Would you share the slides?
Yeah. Let's dive right
in. Yeah. So the agenda for today, yes, is why it's important. So the cost of getting timing wrong, the 5 dimensions, how to time the exit, and then we'll walk you through how to start preparing to sell, hopefully with an M&A advisor, and hopefully you will consider us to accompany you on this journey. So let's dive in. First, we prepared a few stories to open this discussion. And by the way, if you have any questions, do let us know. We'll try to answer them at the end of the webinar, or you can email us later. Anyway, so the cost of getting timing wrong, we prepared 2 categories, let's say. One is sold early, and the other is waited too long. To make you aware of the importance and actually the nuance of this whole exercise to time an exit. So first, we have 3 cases of what are widely considered businesses that the founders exited early. Both are already quite old and mature businesses by now. So you can understand the trajectory of each of these businesses and also the trajectory of the founders. And it's actually very interesting because actually it debunks the concept of sold too early and how difficult it is to evaluate any of human life stories. Because if you look at PayPal, YouTube, Instagram, they all sold in a year of first 2 years from founding. Maybe except for PayPal was a bit more mature. And they eventually turned out to be extremely successful, and they grew to much bigger businesses than probably anyone anticipated. Which makes you think if they only waited a few more years, if they kept at it for a few more years. But the reality isn't that simple. If you take any of them, let's take Instagram, for example, that was sold to Facebook. They sold at 13 employees, super tiny business, pre-revenue, for $1 billion, which looked crazy. And now, it's one of the biggest business lines of Meta, and contributes to its $1 trillion+ valuation significantly. So you could think, yeah, very early they sold. They could have done better. But first of all, I mean, you cannot predict what would have happened in an alternative scenario. And the second thing is, they actually seem quite happy. And there are a lot of interviews with the founders. They never regretted the price, really. They were content with it. They just were regretful of what happened to Instagram, maybe under the new stewardship. And so they quit. But the timing of the deal never occurred to them. Same with YouTube. Very early on, so but had no funding to scale. And also following up on the founder stories, none of them expressed regret. One in particular said was extremely happy they sold because they could take care of their health. PayPal is an even more instructive, informative story because a lot of the so-called PayPal mafia, after selling, they went on to found huge businesses. And actually, they made a very good call to move on and sell the business. And then went on Musk to found SpaceX and Tesla. Reid Hoffman went on to start LinkedIn and so on and so forth. So does that mean you should sell as soon as you get a good offer? Also not. But there is no clear answer for sure that when the timing is optimal for a business, and you can only evaluate this decision in hindsight. Then an informative story was also Yahoo, which at a point was a dominant brand online and was valued in 2008 after the great financial crisis hit still at 45 billion. They declined an offer from Microsoft, and then they, after 8 years, they finally sold for only 5 billion. So, what really we wanted to draw your attention to from these cases is situational awareness. That it is important to understand where your business is heading, where the industry is heading, and where do you want to go as a person, as a founder, or as an investor, what your goals are, and only then decide on the timing. And we hope after going through our material, and we will share it also after the webinar, you'll be equipped well enough to make a good call. So this is a good point to bridge to the 5 dimensions that we will walk you through today. So first of all, the cyclicality of the financial markets and technology markets, which is huge. And I mean, on a high level, it's better to sell during the bull market than the bear market. So we'll walk you through how to tell where we are in the market cycle and how that should affect your thinking about exit. Then the second dimension is the industry cycle, and we'll use the Gartner's hype cycle to help us. Spoiler alert, better to sell when you're closer to the hype, to the peak of the hype. The third dimension, each company goes through cycles. Sometimes they get reinvented, but we'll try to walk you through how to tell where a company is ready, when it matures, when the likelihood that it will grow faster than the rate of return you can earn on the capital. how to tell when the curve is tilting and when the timing is right to sell. The fourth dimension, be mindful if you take on investors or if you're an investor, everyone is on their own clock. And at some point, the tail might wag the dog with investors, especially minority. So be mindful who you take on and what's their horizon, and understand them and include them in your plans. And the fifth dimension is personal. So how to think of basically your career and your personal wealth trajectory, so that you can tell the moment when the right moment to move on and exit the business. So that's in the introduction. We can move on to discuss the market cycle.
Yeah,
Filip?
so we first start usually at looking at the market cycle, and being in the industry, we kind of see it change slowly. It's a very long-term cycle, and there are a number of ways to look at it for your particular market, for your particular country. So here we showed something which is more US oriented, but also replicates in many markets right now, which is a cyclically adjusted price earnings ratio, which measures the valuation levels, comparing current prices with averaged out earnings. Yeah, so for example, now we see semiconductors, memory stocks are having very elevated earnings. So this ratio tries to do averaging of the earnings over the last 10 years to and also implement the cyclicality of those earnings. So if we look at where we are now, 42 times price earnings, this is US stock market. The only time we were higher was peak of dot-com bubble in 2000. So looking at this, we're overall, I would say, at a very good place in market cycles. The companies are not undervalued. The companies are actually very highly valued on public stock markets. And that usually transitions also to private markets, and we can talk about it a bit later. That's not the only way to look at the market. You can look at some traditional economic indicators. It's always best to sell your company when it's an expansionary cycle, boom period, not the recession. So you can look at GDP growth, at interest rates. In some countries, the GDP is very strong. US, for example, is performing very well. There's a lot of capex investment in data centers. There's a lot of fiscal spending. While in some countries it may be more subdued. If you think about Germany, for example, they haven't been growing as fast, so their market cycle will be a bit different from the US. But kind of if you think on a global level, I would say we're not in the recession. The valuations are strong across multiple countries. So on that dimension, when we're speaking to clients, we're usually telling that it's good time right now. The valuations are at historical peaks. So if other pieces of the puzzle fall in place, then the market is basically good right now. How that translates in private valuations, Marcin?
Yeah, so we wanted to look more closely to the businesses that most of our clients are in, so SaaS and IT services, and how over the last 10 years the multiples developed. And you can see clearly, maybe there's on SaaS side, there's an upward trend, clearly. But you can see two peaks in 2019 for the first quartile, and in 2023, which show that, as a matter of fact, I mean, there are opportunities every now and then. And in 2025, we have also a peak where the valuations on the extreme end tend to be higher. And that's when you should take the opportunity and and sell if you have the chance, because otherwise you expose yourselves to the whims of the markets. And they seem quite volatile, actually, which most founders don't appreciate. If you don't have like a decade-long time horizon, you just can miss the signs. In IT services, it's less pronounced, but it's also quite significant. I mean, if you compare the median EV/EBITDA in 2020, like 7.7, to the other years, it's the gap is quite huge. And I mean, we've known founders who sold in 2022, 2023, very happy. And honestly, I mean, there's no way they would get the same kind of money now. So if you have eyes on this, on where the market is going, what your competition is being sold at, you can tell. But this is a conscious effort, and you should definitely collect the data, look at the data, and when thinking about timing, take this into account. I think too few people do it consciously. And most likely miss the window of opportunity. And I mean, when times where businesses are doing good, the market are doing good, it feels like it's gonna last forever, and you feel like you might be missing out if you sell too early. But our experience shows that, and also Yahoo or the likes show that if you have the data, probably you can tell, and you can make the right call. And probably selling a little bit too early is better than way too late, because once the liquidity disappears, mm, it's impossible to go back to the previous valuations. And these things, they can be quite abrupt. The collapses, like the COVID situation, when the market froze basically overnight. So yeah, super important. Be mindful of that and track that closely. So I think that concludes the markets. Now, one of our favorite charts, the Gartner Hype Cycle. If you're not familiar with it, it tracks the development of different technologies over a curve where the innovation starts. There's a trigger for new technology, like Gen AI, for instance, which was, say, a decade ago. Then it goes through peak of inflated expectations when everyone believes that, or the market consensus is that this is the technology that will change the world. Then, as people become more aware of the limitations, it goes down to true of disillusionment, when there is some kind of collapse in optimism, and people get skeptical about the potential. Then, as the company finds the business, the technology finds its niche, its application, we go through the slope of enlightenment and lastly to the plateau of productivity. So that's the framework. What we wanted to say here is that there are three distinct periods when it's worth to sell or wait, or they are neutral, and other factors that are should be taken into account. So first of all, when we're close to the peak of inflated expectations, or when overwhelmingly, we recommend to sell unless you have, I don't know, 10, 20-year time horizon to go on. and fight the fight. We're here in the Gen AI space, I believe, where the valuations are sky high. There's no certainty that these businesses will ever make money. But everyone, or the investors, the markets, they assume they will. And therefore, they put very high valuations on these companies. And if you're in this business, I think it's a good idea to take some chips off the table, because it's quite likely soon we'll go through this disillusionment phase when you will be forced to wait, essentially, because valuations will stay depressed for a number of years until the market reaches its peak productivity. And then the decision has to take other factors. But anyway, as a rule of thumb, when you're close to the inflated expectations, you sell. When everyone gives up, I mean, you don't have much choice. Oftentimes, when valuations are depressed, but if you do, it's better to wait. So this is again about situational awareness and factors that you should take into account, and how the lens through which you should look at your industry. We can move on. Yeah.
Yeah. So the other factor that we look at after the industry is the company life cycle, and kind of when is the right time to sell in your company's journey, because everything usually starts when the business starts. It's early stages, it's growing rapidly, not profitable, maybe you're investing a lot, and then the growth accelerates, you start to be profitable, and then it slows down again, and the business is slowly declining or maybe reinvents itself. And this is a perspective, I would say, very long-term perspective, maybe 10 or 20 years. Also depends on your industry, also depends on the markets overall. But generally every company goes through those stages. Maybe it just depends on what time frame, how fast. Like right now, a lot of AI native companies going through that very, very fast. And some traditional businesses may take 10 years to go through all the stages. And basically the question is, when is the best time to sell? And here on this chart, I'd say it's probably not when you're in startup stage, and not where you're in early rapid growth stage, because at that point you're just not profitable. The company still has a lot of potential ahead, and kind of we don't see a lot of M&A activity in that space. It's just too early, and the risk profile is different. So that's a stage where venture capital investors can invest money in your startup, can basically add capital for you to grow, but not an acquisition. Kind of recently with AI and ease of building software, we're seeing a lot of companies which are very early in their development stage are looking to be acquired. But usually it's just not the right time, because you're not going to get the right valuation, and the risks on the side of investor are just too big. So then kind of the question is, when it is optimal to sell once you enter rapid growth, stable growth, maturity phases, and when you're already a developed company with some profitability or significant revenue. And here, just as an illustrative example, imagine this is the revenue growth of a company. It grows very fast in the beginning, and then slowly deteriorates. The revenue growth slows down and becomes flat at some point in time. The thing is, as with many investors and with the hype cycle, is they think in straight lines, and we as people tend to believe that what historically was true, it's probably going to continue. And it's much easier, for example, at the point one, to make an estimate or forecast or business plan that the growth is going to continue at the same state, at the same level as it was before. Yeah. And when you are at the point 2 in your business development, most people will say, well, the growth has already slowed down, and it's very difficult to forecast anything which is significantly above that curve. And people tend to kind of think in straight lines that if it already stopped, then it's difficult to turn this around. So the story, which is represented here in yellow line, becomes much more difficult to sell to investors. You need to show some exact strategies, some exact business plans, pipelines, and what we're seeing in M&A is then the transaction structure also changes because buyers want to shift the risk to you and pay you for the business only if this yellow projection executes. While in point 1, while you're still growing, it's much easier, and people tend to believe the stories that the growth is going to continue. So when we're discussing that with potential sellers, what we're telling is that you need to still be growing as a business, and we prefer to sell a bit early, as Marcin just said, while the business is still growing, rather than wait for the plateau when it's super difficult to come with a growth story. And maybe your profitability or revenue is a bit higher, but the multiples that companies which are growing, which are not growing, are generating are very, very different. So we feel it's kind of much more paying off to sell at point 1 rather than point 2.
Yeah, in this example, all things being equal, probably the valuations we'd get at point 1 and point 2 would be very similar, very close. So then the question is, why wait? And that's a typical trajectory for a business. Nothing grows forever.
Yeah, and kind of combining this with hype cycle also, it's usually when you're here in point 1, it's likely the hype cycle is better for your business at the same time. Yeah, so investors are usually excited about industries which are fast growth. They look at some companies, they see all of them are growing, so they say, well, this market is great, it's gonna be forever. Yeah, we need to be in that space. While you're at the point 2 and everything is plateaued, it's suddenly just not exciting anymore. And you can think about COVID times, for example, a lot of technology which suddenly became very fashionable and fast growing, everything related to remote work, video conferencing, or for example, the commerce. Yeah, a lot of e-commerce software growing really fast, IT services around that growing fast as retailers invest in e-commerce. And then that suddenly stopped, and kind of the growth has stalled, and this industry is not as fashionable as it was a couple of years ago. Point 4?
Yes, point 4. So chances are you have some investors in a business. They might have joined you at different stages. It's important to be mindful of their agenda, and or even if you don't have, but you're planning on taking on an investor, also important. So we look here at 3 categories. There are other concepts like family offices we don't touch, or that have different time horizons. But the 3 most common angel investors, I'll start with that because they're the most patient. So they tend to invest early on. They invest their own cash, usually, as individuals. So they have indefinite time horizons, and they rarely secure any rights as shareholders to force liquidity. So they tend to be the most patient. They would hold on until it comes naturally to a sale. Obviously, you might get some pressure from them. but so long as they are not dominant in the structure, should be manageable. And you might want to have some internal liquidity options for them, just to buy them out or let them trade with other shareholders if you have to deal with it. The second most patient group, private equity venture capital companies, they tend to be also early investors. They come after angel investors. Structured as a partnership, limited partnership, typically, they do have 10-year time horizons, but because a lot of these businesses are moonshots, let's say, that they invest, they have to allow for outcomes when these businesses do actually go to the moon, and they tend to have some flexibility and can extend their duration, especially if a business is doing well. But they're time bound anyway, and eventually they will have to sell. Private equity, especially leveraged, with that finances deals with bank debt, is the least patient from these three. As a setup, also a limited partnership, they tend to have 10-year horizons. They invest in the first 5 years, they sell in the last 5 years, but also because of the debt that they need to repay. Oftentimes, there's the bulk of the debt is repaid at exit. They might have the most pressure. So whenever you deal with any of these, be aware of what's on their agenda, and this is something you need to manage. And that might not, as from a founder's perspective, might not be optimal. So it's good also to have good relationships with them and ways to manage their exit so that they don't affect adversely your business. So important, not much you can do, honestly, once they're there, but a lot when you decide on inviting them to your cap table. Good. So this is you, Filip. This is your slide, no?
Yeah, I can discuss this. So the fifth dimension is your individual personal goals as a founder, as a business owner, which may be very different and not related to valuation at all, or timing. What's the optimal timing? When is the highest valuation? And here I wanted to illustrate that with the, everything needs to be considered in some particular time frame. So here in our example, there's a business which grows, starts with a $5 million valuation and then grows to $100 million valuation. And then with some assumptions of 15% revenue growth, 20% margin, it will take 15 years to grow from 5 to 50 million. Yeah, that's quite a reasonable assumption for a business, maybe operating not in the fastest growing space, but generally to keep up 15% growth over 15 years, I think that's quite an achievement. So the question is kind of how much is your time worth? That's the one which needs to be answered by every individual business owner. And because the valuation, in theory, if you have a growing business, will continue to grow forever. The question is where to stop, and the issue is the further you go down that curve, the faster it may grow. Yeah, so it took 15 years to grow from 5 to 50. It takes just 5 years to grow from 50 to 100. And I think if we continue that curve forward, it's going to be even faster. But it's usually a set of personal decisions and your personal goals on when to decide when is the right time to stop, to sell a business, to transition it, or or something like that. Yeah.
Yes. So to help with taking into account these non-financial factors, we've listed a bunch of things that are important to time the exit and make a decision whether you want to fast forward to it and speed it up, or maybe you want to postpone it. So the first thing, I mean, the foundation really is financial security and financial independence. Because selling a business that doesn't that is your main source of income, that doesn't offer you after the exit security, is not the greatest idea, because you have to come up with a different occupation essentially. And for someone who's been a founder, I think it's very hard to get a job. Um, so it should be an amount of money that is sufficient. And also, I mean, setting up a new business, if is risky and you're not guaranteed to succeed. So this is the first factor we usually look at, whether you as a founder, you get enough money to feel comfortable after the sale. Once that bar is clear, then it's a matter of really how much is enough and what's the lifestyle you want to maintain. So the second factor is the balance and balancing act between getting more money essentially and getting this extra million or 10 million or 100 million. And also there's also one paradox here, that a lot of people don't know what to do after they sell a business, and they're actually lost and might get depressed, because their role as a business was the foundation, as a business owner and as a CEO, was the foundation of their identity, and that kept them busy and that kept them happy. So leisure, selling a business might not necessarily be a better solution. It might be better to hold on. And a lot of founders, they work in their businesses long into their 70s and 80s, and they never really give up on being active professionally. But at some point you have to give way to someone younger. So they're all important soft factors that you have to answer yourself, essentially. The third point, fulfilling your professional ambitions is also super important, but money is not the only thing that matters. And as a founder, you probably don't start with money in mind. You want to build something, achieve something, serve your clients, deliver on a promise to them, and potentially your investors. So it's important to define them, and an exit may actually help them, because by joining forces with a bigger partner, you can actually make them a reality faster. So this is a multi-dimensional actually question. How does a deal affect the likelihood of you getting more fulfillment of this adventure? And lastly, defining your next chapter. It is important because, and I mentioned before, I mean, a lot of people love their businesses. They can't imagine living without them. So it's important to build scenarios, define yourself. Are you a founder of a single business and that's your mission for your whole life? Or you're better at building and selling, and you want to build a new business? or maybe you want to move on from running businesses because it's too stressful or something, and you want to become an investor, a capital allocator. So there are a lot of journeys, a lot of preferences, and it's important to look inside what really excites you and take this into account when deciding on a sale. So we hope this helps a little bit to structure the thinking around it. And we can move on to more practical things. So how to prepare for the sale.
Yeah. So if you decide to sell, then preparation is really important. And here we outline some plan where you can start even 24 months out. Of course, I would say if you're at the peak of a market cycle and hype cycle and company and everything, I would rather do it faster and don't focus.
Did we lose Filip? I
If
think we
you're,
lost. Oh, okay.
yeah, I was telling
I
that
think we lost the first.
yeah, that any gain in terms of preparation is worse than being at the right place in terms of your industry and market cycle. So if you're at a good place in the cycle, it might make sense to start the process sooner. But if you have some time to prepare, if you're thinking more long term, then starting 24 months out, because the most long term decision is usually succession for most of the business owners, especially if you're planning to leave your company after the sale. And that's where you need to plan it, hire someone or promote someone internally, start to transfer relationships, start to transfer some of your responsibilities. So by the time you're going out to the market, you have a new CEO in place, and it's a very reasonable and kind of believable story that the business has been transitioned and you're doing less in it, and that it's actually true. And after you sell, nothing kind of important gonna happen. 11 months out, or 18 months out, you can start thinking about cleaning up financials, kind of starting to clear the company from non-operating expenses, clean the company from some of your own expenses and stuff, which we typically see in private businesses. And also build an early relationship with buyers, especially strategic ones. Strategic buyers are typically moving very slow. They need to have internal alignment if they want to acquire your business. They want to monitor it maybe for some time, understand internally how it fits. So if you're planning to sell to a strategic investors, that would be the right time to start building some relationships and hint at an acquisition. Because if you do it too late, and those big bureaucratic organizations might just be too slow. 12 months out is when you can engage M&A advisor, start building equity story, preparing for the actual process. It's probably 6 to 12 months is what it takes to run the full process from start to end. Then you start building your marketing materials, teasers, financial models, and so on and so forth, long list of buyers. And then 6 months out, you launch the sale process, start negotiating with investors, getting offers, going through the diligence, and then eventually selling the business. Most of the investors will require you to stay on for some transition period or for an earnout period if your structure is negotiated in such a way. But after that, it's usually handover to a CEO that you selected or to some new CEO, someone internally at the company, and the deal is essentially over. Yeah.
And that concludes our webinar. If you have any last minute questions, feel free to type them into chat. If not, we would refer you to our tool that we've built, Exit Timing Dashboard, where you can answer a few questions that follow our framework here and get an answer. When are you ready? Where are you on your path, essentially, towards the sale? So we will email you the link to our tool and the recording from this webinar. And if you'd like to discuss your exit, feel free to reach out, and happy to have a chat and give our assessment about your situation and your business and where we are where we think we are in the market cycle. So thank you for joining today, and we welcome you we hope to see you on the next one.
Thank you. Thanks everyone.
Thank you. Bye.
Bye.